Good Monday morning. 30 minutes till the start of the cash trade. I'm Matt Miller. Dani Berger is on assignment. Bloomberg Open Interest starts right now. Coming up, big moves are brewing in tech M&A. ServiceNow eyes cybersecurity startup Armis for $7 billion. Intel circles AI chipmaker SambaNova for a big discount. And Mckinsey is looking to get leaner with plans to cut thousands of its own jobs. Plus, a new playbook for the new year. Wall Street says the Mag 7 won't run the show in 2026. Take a look at some of the big stocks that we're watching in terms of deals. ServiceNow right now down about 6% in the pre-market. Intel, on the other hand, gaining 1.33% as it looks to pick up potentially SambaNova for $1.6 billion. That company was valued at $5 billion in 2021. In terms of talking to someone at Bloomberg Intelligence about this, we have him on the desk here. Mandeep Singh, he's the head of technology research for BI. And Mandeep, this is, to me, fascinating because Intel's CEO, Lip-Bu Tan, is also one of the early investors in SambaNova through his venture capital firm, and he's the chairman of the board at SambaNova. So is that why he's getting such a sweet deal?
I mean, right now, the moves that he has made, whether it's the cash infusion from NVIDIA or the government taking a stake in Intel, seem to be headed in the right direction. And look, Intel doesn't have a great track record with acquisitions. We know that. And so he's trying to change that. And I think $1.6 billion is not a big amount. So like you said, it's a big drawdown from their prior valuation. And I'm honestly surprised, given a company that's exposed to, AI accelerator chips with a decent revenue and a good exposure to sovereign play. I mean, the thing about SambaNova, and they were at our conference, is they really specialize in the Middle East. And they have a big partnership with the Saudi sovereigns in terms of deploying AI there. And it sounds like a pretty sweet deal for Intel in terms of valuation.
Yeah, right. We should stress, this is according to people familiar. It hasn't been confirmed, so the value could change. But I just think it's fascinating that SambaNova was valued at $5 billion in 2021. And since then, the SOX index has tripled in value. I actually spoke to the CEO on this program last month. Let's listen to what he said.
We've been getting a lot of interest over the last few months around investing in the company. But look, every scenario we consider is about growing our footprint, accelerating our roadmap, driving our product into the market faster. We see quarter over quarter doubling of our business, multiple quarters in a row now. And so we're excited about that. And so we're just really excited about figuring out how to actually accelerate that into the market and growing faster.
So I did ask him as well about Lip-Bu Tan being the chairman. It's interesting that they have done so well, and yet they would sell for relatively so little.
Yeah, and even, Cerebras, Grok, all these companies were looking to compete with NVIDIA by specializing on certain aspects of inferencing or training. And in this SambaNova's case, they did make a pivot from training to inferencing. But it sounds like he was quite excited about the opportunities in the Middle East. And to my mind, Intel, will benefit in the sense like they need somebody on the AI accelerator side to really come in and manufacture their chips on Intel fabs. They really need to get that going to draw, someone like AMD or one of the bigger players to come in and make use of their fabs. And I think by acquiring SambaNova, which is an AI accelerator company, hopefully pivoting them to use their own Intel fabs as opposed to manufacturing their chips on TSMC would be part of the strategic vision that Intel may have with the SambaNova purchase.
All right, I want to finally ask you about the ServiceNow, the potential deal there. Also, according to people familiar with the matter who declined to be identified, they could be picking up Armis for as much as $7 billion. This is what, like an Israeli intelligence company that tracks threats on devices?
Yeah, and look, Google still has that pending acquisition of Wiz for $32 billion. So clearly security is a hot sector when it comes to M&A play. And it makes a lot of sense. I mean, the world is changing in terms of how enterprises are thinking about upgrading their systems. There will be a lot of API activity. We know in the world of agents, the UIs will change. And so to prevent, prompt injection and all these sort of new attacks, you need to beef up your cybersecurity, which is why ServiceNow, an application software company, seems to be delving into cybersecurity through M&A and paying up. I mean, this is more than 20 times, sales for an asset, which is a private company. And look, it does make
20 times sales.
Yeah. I mean,
wow.
That's how the cybersecurity multiples are right now.
Yeah, they have $300 million in annual recurring revenue, but up from $200 million just the year before. So what a really cool sector you cover, Mandeep. And we're grateful to you for coming on our program so much. Mandeep Singh runs tech coverage for us at Bloomberg Intelligence. Now, partners at consulting giant Mckinsey are discussing job cuts at their own firm, and it could be in the number of thousands of employees. Leadership could cut staff as much as 10% across non-client facing departments over the next 2 years as revenue growth flatlines. Bloomberg's Wall Street chief correspondent Sridhar Natarajan reported on this and joins us now. So McKinsey, typically the one to say you should cut jobs at your firm, now looking to slim down itself.
It's a window into the challenging period that the consulting industry overall is facing. This is not a McKinsey-only issue. And you have to be mindful of the fact that in the prior decade, McKinsey had really grown its headcount quite a bit. However, we've seen a little bit of flatlining in their revenue over the last 5 years. And that is why, despite the bravado in front of the partners, where their global managing partner, Bob Sternfels, was just recently talking about this idea that they're ready to kick some ass, that those who believe in this mission will see good times ahead, that there is a more pragmatic message percolating through the entire firm, and that is, it is time to get leaner. And they rightly point out, one of their spokesmen actually tells us that much as they advise their own clients, they realize there is a need for some efficiency, especially in their support functions.
I saw in your story from 2012 to 2022, they'd gone from 17,000 at one point to 45,000 employees. So beefing up massively at the same time. Well, now, as a lot of consultancies, a lot of law firms, a lot of banks are saying we don't necessarily need to hire as many first-year employees because AI can do all of this work for them.
And it is notable that they themselves, in their own statement, flick at the idea that AI is having profound impacts on business and society. And yes, that is why, even in the last 2 years, you've seen McKinsey's headcount go from 45,000 to 40,000. So it will be interesting to see where the headcount actually ends up in 5 years from now. These things never move in a straight line. The last time around, they had a big round of job cuts. They called it Project Magnolia internally. They said about 1,400 jobs will be lost. That would be 2 years ago. But when we hear 2025, end of 2025, the headcount reduction, actually, the net reduction is down 5,000. So that could well be tapping some consultants on the shoulders and saying, time to get out, not hiring as many. So because of all the changes ahead of us, challenges faced by the consulting industry, and rightly what you point out, when they look at their clients and whether the changes you're seeing at law firms, even banks at the initial stages, at the junior stages, how will the consulting firms react to that? And how does McKinsey, the flag bearer of that industry, react to that? It will matter quite a bit.
All right, fascinating story, one of our most read today. Shri, thanks so much for joining us. Bloomberg Sridhar Natarajan covers Wall Street for us. Now, after years of the Magnificent Seven driving market gains, Wall Street strategists see great sector rotation into underperformers like financials and consumer discretionary stocks in 2026. Bloomberg's Alexander SambaNova reported on this, and I just saw that the financials hit another record high on Friday, even as the rest of the market cratered.
Yeah, and that's likely to continue going into next year. The resounding message from Wall Street is if you want to keep capitalizing on this bull market, you have to take your money out of the big tech high flyers that have been doing very well over the last few years and put it into some of the ho-hum old economy sectors like financials, industrials, energy. Part of this thesis is, of course, that the Mag 7 have run up some 300% since this bull market market began in October 2022. So the bar is very high when you think about valuations and monetization of AI. But the other more optimistic part of the argument is that people expect the economy to reaccelerate in 2026 thanks to Fed easing and Trump's tax bill. So that is going to bode well for sectors like transportation and manufacturing. At Bank of America, Michael Hartnett calls this the rotation out of Wall Street and into Main Street. And if you look at some of the price action in recent weeks, we're already seeing it happen. If you look at the near-term low on November 20th, since then, the Russell 2000 is up about 11%, and the Mag 7 about half that advance.
So what's the expectation for earnings? Because we saw this year, kind of a head fake. We expected the S&P 493 to start growing earnings more, and we do obviously see the Mag 7 slowing down because they had grown at such a fast clip.
Right. So we're once again on track for double-digit earnings growth in 2026, and that is going to obviously help gains at the index level, why strategists are so optimistic going into next year. But as you mentioned, Matt, that gap between the 493 and the Mag 7 is expected to narrow. If you look at the first quarter, the Mag 7 are expected to post year-over-year growth of 15%, and the rest of the index 11%. So that catch-up is really going to materialize.
All right, Alex, thanks so much for joining us. Alexander SambaNova writing on sectors that could benefit next year other than the big tech sector. Now, check on what's going on in futures after the market closed down more than 1% as measured by the S&P on Friday. You can see right now we have S&P futures up 0.6%, NASDAQ futures gaining 0.75%. In terms of the individual movers on our radar, Roomba parent company iRobot filed for bankruptcy and proposed handing over control of the business to its main Chinese supplier. As a result, this already small company gets even smaller in market cap terms. Netflix said its position on its deal for Warner Brothers Discovery has not changed since the hostile takeover bid from Paramount. Netflix shares up 1% this morning in an up market. Paramount shares also gaining in the pre-market. Warner Brothers, little change. Logistics firm GXO says Brad Jacobs will step down as non-executive chairman of the board at the end of the year. Brad says he's going to focus on QXO, one of the many three-letter businesses that he has been running. Coming up, President Donald Trump names his top choices to be the next Fed head. We'll take a look next at who it could be and what that will mean for rates. This is Bloomberg Open Interest. It appears the race for the next Fed chair is down to 2. While talking to the Wall Street Journal, the president named Kevin Hassett and Kevin Warsh as his top 2 choices. Polymarket odds had Hassett as the clear frontrunner, but Warsh is closing the gap considerably. Here with me now is Michael McKee, Bloomberg International Economics and Policy Correspondent. And I know mystery is a big part of the strategy of this administration. But previously, the president said he knew who he was choosing. He had his pick.
Yeah, well, do I have to remind you, this president is Donald Trump, and he never does anything in a straight line, shall we put it that way. He did tell the Journal that he is thinking of both Kevins, and he did interview Kevin Warsh again last week. But that doesn't mean he's not going to be interviewing other people, as far as we know. There was some talk of a whole second round of interviews, and he has given us conflicting data on when he intends to name a choice. Now, the question is, between the two of them, what is the difference, or does it really matter? Kevin Warsh, probably more hawkish. Kevin Hassett has a reputation perhaps as being in the president's pocket, but they both will come to a Fed that already has a lot of people in place who may not want to do what they want to do. You look at who was appointed. Hassett or Warsh would be appointed by Trump, along with Mickey Bowman, vice chair, and the Governor Chris Waller, if he's not chosen as chair. But the rest of them all were appointed by other presidents. And I left Powell in there because we don't know if he's going to quit yet. And so how much influence is the new chair going to really have, at least in the short run? He will have some opportunities. Jay Powell has 3 more rate meetings before he leaves, but the new chair will have 5. So it is going to be June 17th that everybody's going to be focused on once we get the name and they get in place. June 17th, the first Fed meeting with that person as chair.
And that's why the odds jump considerably of a rate cut in June. If you look at the WIRP function on the terminal, all of a sudden it goes from like 20 to 50. I wonder what you make of Scott Bessent has talked about having regional Fed presidents, actually live in that district and have a 3-year period of residency there. That could change the makeup of the regional Fed presidents, although he says it would take an act of Congress. How much further can President Trump, can this administration shake up the Fed?
Well, that's going to depend on the court case before the Supreme Court on Lisa Cook, because if the president's given permission to fire at will, then he could get rid of other governors and appoint new people, and he could also get rid of members of the boards of directors of the local regional Fed banks and their presidents and try to influence it that way. But it isn't clear that that would get very far under the law. We got to wait for the Supreme Court to decide. And then, as you say, the idea of putting residency requirements or any other requirements in would require Congress to modify the Federal Reserve Act.
All right. Mike McKee, thanks very much for your coverage. I'm sure we'll check back in with you quite a bit this week as we get non-farm payrolls, delayed non-farm payrolls, as well as CPI and other economic data. Let's get to high interest now and look at what's making headlines around the world, and it is grim, as you can imagine, after the past couple of days. Australia pledged tougher gun laws after a father and his son killed 15 people at a Hanukkah celebration on Bondi Beach. One of the shooters was killed. Officials are labeling it a terrorist attack targeting Jewish Australians. The incident has ignited fierce debate over anti-Semitism, gun laws, and national security. Brown University canceled finals and sent students home after a campus shooting killed 2 and injured 9 over the weekend. Thousands sheltered in place for hours as police searched for a suspect. Students say they're shaken, many fleeing campus early, while leaders urge mourning and recovery as the investigation continues. Tributes are pouring in for celebrated director and actor Rob Reiner and his wife Michelle Singer Reiner after the couple was found dead in their Los Angeles home on Sunday. U.S. news outlets reported both appeared to have died from stab wounds. Police are investigating the case with no suspect identified yet. Reiner, 78, was beloved for classics like The Princess Bride and When Harry Met Sally, and for his decades of political activism. A weak payrolls report tomorrow could increase the probability of more rate cuts, and that could be a boon for stocks. Morgan Stanley's Mike Wilson says we are now firmly back in a good is bad, bad is good regime. This implies that moderate labor market weakness is likely to be viewed in a bullish context by the equity markets. He says the equity return to interest rate correlation is falling deeper into negative territory. Let's bring in Citi Wealth Chief Investment Officer Kate Moore. And Kate, it's always kind of depressing when bad news is good news, but we've seen this movie before. What do you think about this this prediction from Wilson?
Look, I think there's something to it, Matt, which is that we're in an environment where people have had a good risk-on year, and they're starting to get a little bit antsy about their overall positions. I would classify sentiment as kind of tepid at the moment, and you've seen this in terms of some of the rotations happening in the market in this final month of the trading year. But what I would say is we're actually seeing plenty of good reasons to think that nominal growth is going to be strong in 2026. And, if we end up getting a solid payrolls number, it's kind of hard to predict. There's obviously a lot of noise, but most of the labor market data we've been looking at has actually suggested that there's been decent labor market strength. One of the things we've been anchoring to is the tax receipts, which are consistent with people having money and companies having money and individuals having money and not actually facing job losses. So we're going to take the payrolls tomorrow as part of our overall data picture for the labor markets. And we would say the economy looks like it's in solid shape and likely will be strong in the first part of next year. If that scares people because they've been positioning in secular winners instead of thinking about beneficiaries of economic growth, so be it. But we have a positive outlook for the next couple quarters.
I mean, do we need more rate cuts from the Fed? We've already cut 125 basis points since October, November of last year. And in that time, by the way, the 10-year yield has remained at the same level, still around 410, 420. Is it really helping if the Fed cuts rates?
You know, we always know that monetary policy works with long and variable lags anyway. So these cuts that we've had in the very recent past would take some time to feed into the overall economy to begin with. Secondly, we're actually seeing plenty of signs of stability. And while it is fair for us to talk about, weakness in the lower end consumer, that's been persistent for 4 to 6 quarters here. So that's not a new feature. And we've also seen a significant amount of dissent and discussion amongst the Fed presidents, not all of them voters. And we think they are also seeing some regional areas of strength as well. So it's not a slam dunk for us that the Fed cuts at every one of the next couple meetings over the course of the first quarter of 2026. And as I said before, we are very firmly in the view that nominal growth is going to look strong in the beginning part of next year, supported by, kind of a broadening of the consumer and what we're seeing support from the tax bill as well.
If I look over the year to date, Kate, at the sectors that have done well, communication services, these big hyperscalers and IT are the top 2 winners. Really, every year to date, every one of the GICS sectors has done well. But at the bottom of the pack, real estate, consumer staples, energy, consumer discretionary. Do you see any of the underperformers picking up in 2026, the kind of dogs of the Dow theory?
Yeah, so we've done a bunch of work on this, Matt, and what we will say is, some of the stuff that has underperformed this year just has incredibly weak fundamentals relative to the tech and tech-enabled companies that have been outperforming. And we don't want to rotate for rotation's sake. There's a lot of people who are calling for rotation in the first part of next year simply because they like this kind of dogs of the Dow theory, or they want to kind of get out of the momentum trade and they want something to say. But we're really, really grounded in fundamentals. And we're looking at where the strongest earnings growth is and is expected to be in the next couple quarters.
All right, Kate, stick with us. We're going to go to a break. Then we come back with the opening bell, and we'll be back with more Kate Moore from Citi. Moments away from the start of trading on this Monday morning. This is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures rally this morning after a drop on the S&P of a little more than 1% on Friday. Of course, we did have a record high on the indexes last week as well. So coming off of that a little, but now we're gaining into the Monday open. The NASDAQ doing even better, up 0.75%, and small caps gaining about 2/3 of 1%. You look at the New York Stock Exchange. Ron Barron ringing the opening bell there with his colleagues at Barron Capital, celebrating a couple of their active ETFs. That has been really the flavor of ETFs this year. You'll know if you watch ETF IQ, which, by the way, is on today again at 12 noon with an extra special guest. Tractor Supply ringing the bell down at the NASDAQ market site, and Beyond Ready. Looks like they have some Girl Scouts down there, maybe. This is a company, sorry, it's a 4-H thing. I should have noticed by the clovers. This is a company, a stock that has kept pace with and actually outperformed the S&P just barely. If you include reinvested dividends, it's up 99% and change over the last 5 years. The S&P up 98% and change. Take a look at a couple of the companies involved in deal news this morning. ServiceNow is one that we're watching. It's in advanced talks to buy the cybersecurity startup Armis in a deal that may be valued as much as $7 billion. This, according to people familiar. The same is true of Intel. It's in a deal, in deal speculation, I should say. People familiar say it's looking to acquire AI chip startup SambaNova for about $1.6 billion. Including debt. Let's bring in Citi Wealth Chief Investment Officer Kate Moore. And Kate, just to talk about the animal spirits in this market, deals, IPOs, everything seems to be back on track. Does that hold into 2026 with the tailwinds that you were talking about economically? Sorry, did you mute yourself?
I must have muted myself. I'm sorry about that.
I'm just so glad we still have you.
Yeah, I'm so excited while you were giving your market update a moment ago that I had to turn off my my audio. what I'm thinking is that for 2026, we'll have a continuation of a bunch of this capital markets activity. And I just want to point out, Matt, that there's a bit of a disconnect here between what has been solid capital markets activity, where we're seeing actually a significant amount of interest across a variety of different asset classes, and people's concerns that there are weakness in parts of the economy and that the Fed should continue to cut rates. These two things are not really that consistent. In an environment where the economy is weakening, the labor market's weakening, where we have to be sort of worried about the forward growth trajectory, companies are not going to be coming to market, and acquisitions and targeted events will not likely happen. So we're of the view that capital markets activity will pick up again in 2026, and that it will be an opportune time for high quality companies to offer shares to investors.
So do we need rate cuts? This is kind of the question I was trying to get at before the break. Do we need rate cuts in order for companies to post double-digit earnings, for stocks to continue to climb? I mean, can't things do well on a markets and economic level without the Fed cutting rates?
Yeah, I think that the economy and the markets can do well without additional rate cuts. But look, no one's asking me to be an FOMC voter at this point. We have been talking about this, though, since the beginning of October, that it wasn't a slam dunk that the Fed would cut rates, at the October and December meetings, and that we were likely going to see actually some economic data and some behavior on the part of consumers and businesses that was more supportive of a growth environment. The one thing we've also been talking about, Matt, which I think is a little bit different than others, is that inflation may stay a little bit warmer. I've called it spicy, but a little bit warmer than some people are expecting. The ideal environment for a lot of people's positioning into next year is that you see inflation coming down meaningfully close to 2, or the lower parts of 2, and economic growth being strong. But we actually think that prices are going to remain relatively elevated, closer to that kind of 3% level. And that also makes the Fed decision a little bit harder. So I don't think the Fed needs to continue to cut rates. Our assessment of the economy and of prices and inflation would suggest that they can pause and wait to see what the impacts of some of these rate cuts have been, and that we're likely to see strong activity from some of the fiscal tailwinds, as well as some of the secular trends as well in the beginning part of the year.
We've seen inflation in commodities for sure. I mean, gold, again, near a record high, but many of the other commodities in the Bloomberg Commodities Index have rallied to highs. That's, I guess, emblematic of the inflation that we've seen, but will it continue?
Yeah, we think it will. In fact, we added a little bit more gold to the portfolio last week, and you could say, Kate, why are you guys doing that when gold is up, kind of 65% year to date? And the truth of the matter is that we're looking at gold as a portfolio ballast, not just looking for price appreciation. And even though I have a constructive view on the overall economy and we think markets will move higher over the course of next year, we still want to build resilience in portfolios. I think there are a lot of allocators like myself that are making this consideration and are having these discussions with our committees. So it's not just wealth organizations. It's also pension funds, other institutional investors, sovereign wealth funds who are looking to add a little bit more gold and build that resiliency into portfolios, particularly if long duration may not play the part it has historically in terms of providing equity ballast. So that's part one. On the second thing you were mentioning in terms of commodities, we've also been constructive of commodities and actually see some of the upstream plays in the AI and tech side as being an interesting way to broaden out on that specific theme. That's been a favorite topic of ours over the last couple months. And I think we'll see more and more people get excited, both from the growth side as well as the supply-demand features of many of these commodities, industrial metals in particular, as we go into the continued tech build-out.
So are these companies, is this economy doing well enough, strong enough to overcome higher commodity prices that may continue to rise, higher rates that may continue to rise?
I think so. And look, we're going to have to be on watch for data points that shake this narrative, that shake our conviction. But we are super data focused on our team, and everything that we're seeing right now suggests that higher commodity prices and even this slightly higher inflation than many people are expecting can be absorbed and dealt with in this economy. So at this point, we see no cracks in the story. Yet I do want to recognize that many people are kind of positioned for solid nominal growth next year. And that's always a risk when you have consensus. You know this very well, Matt, when consensus is very crowded around a specific view.
Absolutely. I want to ask also about, regional investing, because for so many years, we thought maybe Europe would outperform the U.S., and it never happened. And now it finally has, to a pretty serious degree. I mean, even without currency, I look at the gains in Madrid of 46%, the gains in Frankfurt of 22%. Those are both better than the S&P gains. Does that continue? I mean, around the world, do you see places that are maybe even more interesting to invest in than America?
Yeah, it's been really notable to see the very significant outperformance or the very significant performance of some non-US markets this year. Actually, even more than Europe, which I think was a lot about multiple expansion and not really about fundamentals driving it. And again, we're very fundamentally driven in terms of how we allocate our equity risk. We've been really focused on the significant outperformance in terms of emerging markets, and particularly emerging Asia. We're lucky enough to have been, very well positioned and overweight in this area, and we've had a very strong position in China. That's been a great portfolio adder over the course of 2025. We still see the opportunity for these areas, and particularly EM Asia and China, to outperform. But again, that's driven by fundamentals, what we think are like solid earnings trajectories, rather than the more multiple expansion and kind of the value rotation that some people engaged in that led to sort of Europe doing well. So I think there are amazing high quality companies in Europe. Many of them already are kind of priced on par with their U.S. peers. They're not like trading at a discount. And we want to be really kind of focused on taking more active risk in Europe, rather than saying, hey, we're betting on further multiple expansion, when we think the U.S. has the strongest and most consistent earnings trajectory.
Kate, great to get some time with you. Thanks so much for joining us. Citi Wealth's Kate Moore talking to us about these markets and this economy. Let's get a check right now on what the major indexes are doing. 10 minutes into the session, we're still looking at gains here, about 0.3%. So the S&P adding 20 points. If you take a look at the winners and losers, we're looking at 350 roughly gainers, 150 losers, so pretty decent breadth. If you look at who's adding the most, Tesla adding even more than NVIDIA, so that's interesting. Tesla right now up more than 4%, NVIDIA gaining 0.75%, and then you see some non-tech firms, Lilly, JP Morgan, KLA. On the downside, Broadcom is once again off today, off about 2% right now, taking 4 points off of the S&P 500. Apple is down only 0.6%, but that's good for 3 points loss. And then ServiceNow, we've been talking about the potential deal there, down 8% and change. If you take a look at some of the sectors that we're watching very closely, we showed you year to date earlier. This is on the day. Almost every sector is gaining, only energy and communication services. These are the hyperscalers not doing a lot this morning, but we do have consumer discretionary gaining. We have healthcare gaining, financials and industrial. So this could be a little bit of a defensive play in terms of what's bringing us up here. When we come back, we're going to focus in on Fannie and Freddie. It's long been talked about. They've quietly boosted their investment portfolios in recent months. This adds to the speculation around an even more public offering for these shares that you can already trade. This is Bloomberg Open Interest. Time now for our top call. Some of the analyst action and focus this morning. First up, BofA Global is upgrading Bristol-Myers to a buy, arguing the company is heading into a stretch of pipeline milestones that could reset expectations and reignite growth. The firm calls Bristol-Myers a catalyst-rich story heading into next year, and those shares are up almost 3%. Next up, Goldman Sachs upgrading Teradyne to a buy, arguing that AI-fueled demand will reignite its chip testing business. Longer term, Goldman says expanding chip sizes and stricter quality requirements should keep pushing Teradyne's revenue higher. That stock also up by 3% in the early trade. Finally, KeyBank is cutting Adobe to a sell as part of its 2026 software outlook, arguing that competition is heating up. KeyBank prefers smaller software names over large caps heading into next year, framing Adobe as less attractive in that shift, and those shares taking a little bit of a hit. Now, Fannie Mae and Freddie Mac have added billions of dollars of mortgage-backed securities and home loans to their balance sheets in recent months. That's adding to speculation they're trying to lower lending rates and boost profitability ahead of a potential secondary offering. Bloomberg's Scott Carpenter covers credit and joins us here on set. Scott, great to have you on the program. This is a story that has been persistent because Bill Ackman often tweets about Fannie and Freddie. The president and those around him talk about it a lot. But for many people, what these companies do, these government-related entities, is kind of nebulous. So step back and explain exactly what the story is.
Yeah, absolutely. So Fannie and Freddie are enormous government-sponsored companies. They're designed to support the market for home loans and ultimately make it easier to take out mortgages. They underwrite something like more than half of all mortgages in America, so they're enormous, right? The main thing they do is they provide a financial guarantee on mortgage bonds. That's how most of these home loans get financed. That's the main thing they do. They also, and this is the part that's not talked about quite as much, they also buy some of those mortgage bonds and home loans themselves. By doing that, they can support the market and also earn revenue for themselves. They get money from providing the financial guarantee. They charge money on that. They also get money when they buy the mortgage bonds. So it's sort of like, for them, it's called their investment portfolio or their retained portfolios. This is in addition today to their main business of providing the financial guarantee. And what's been happening and what we wrote about is that since June, between June and October, they've increased that investment portfolio by about 25%. It's now roughly $233 billion. That's a lot. The agency mortgage bond market is enormous. It's about $9 trillion. So still, it's not the whole thing by any stretch, but it's growing. And what people are talking about, what all strategists, a lot of investors I talk to are talking about, is that it's on a trajectory to continue growing into next year. Citigroup is expecting them to add $100 billion. There's a wide range. Nobody knows exactly what they're going to do because Fannie and Freddie and their regulator, the FHFA, have been tight-lipped about this.
So, but let me ask, clearly if they buy mortgage bonds, that'll push the rate down, right? Price up, yield down.
Yeah.
But why would they want to keep lending costs down and grow their portfolio as a precursor to what's being called an IPO? Although, obviously, it's not an initial public offering since the shares are already pretty public.
Right. To do an IPO, which is what the Trump administration is clear they would like to do, the GSEs, Fannie and Freddie, need to have really good earnings. If you're going to invest in an IPO, if you're going to buy shares of a company that are being offered publicly, you want that company, or in this case companies, to be very profitable. So you want them to be quite profitable, right? And this, by increasing the investment portfolios, you're increasing the earnings, although it depends on what your funding costs are and so on. But that could be what's going on here. They have the IPO in mind as well as other possible objectives like lowering mortgage rates, and they're thinking, how do we make this possible? One way to do that could be buying more mortgage bonds, mortgage loans, increasing their earnings, presenting better profitability, so that when it comes time to do an offering, investors like what they see.
All right, this is something that I think we're going to be talking about a lot more over the next year, Scott, so I hope we can get you back on. And fantastic coverage, great story today. I hope a lot of people read it on the Bloomberg or on Bloomberg.com. Scott Carpenter writes about credit for us. Coming up, gold climbs to, well, near fresh records again, given a boost by the Fed's latest rate cut. We'll look at the year ahead for the precious metal. That's next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Get a quick check on stocks with the chicklets. Right now, almost a half hour into the session, the S&P 500 is gaining, but less than 0.2% so far. The NASDAQ up also about 0.2%. Remember, we had a big drop in these indexes on Friday. The S&P ended up closing down 1.1%, and the tech stocks were really the drag on that. Taking a look at the biggest stocks here, NVIDIA actually up 1 1/3%, so that's going to help lift the index. We saw just moments ago that Tesla and NVIDIA were the biggest gainers on the S&P. Oracle on the downside, Oracle and Broadcom both weighing on this index, this market. iRobot is the Roomba maker that's filing for Chapter 11 protection from creditors, so that's down 70%. ServiceNow is down 10%. Wow, really decimated on reports that it's going to buy Armis for a $7 billion valuation. And then we have gold and silver. We've seen new record highs. Well, silver has seen a new record, and gold is getting back close to the record that it recently hit. So we do see commodities continuing, at least in terms of precious metals, on the upside. For more on gold, we're joined by Bloomberg macro strategist Simon White. And Simon, we just spoke with Kate Moore of Citi Wealth. She said she's adding to her portfolio, even at these lofty levels as well. Can this rally be sustained?
Well, I think you have to kind of stand back and look at the bigger picture. The rally that we saw, for instance, in the late 70s and the early 80s was something that was, remarkable at the time. But if you look at today's rally in comparison, it's still barely a scratch on that. I'm not obviously saying that necessarily it's going to go to the same extremes. We're already ahead of it in nominal terms. But in terms of when it's a regime shift, which is what I think we're in today, you have to keep an open mind. So, I think it could be a slightly more tougher year for gold next year. Like, it could be more volatile. There could be a pullback on the way there. But the fundamental reasons, I think, for the bull market remain intact. So
what is driving this? What are those fundamental reasons? Why are we seeing gold at well over $4,300 a troy ounce?
Yeah, I think, look, there's quite a few things going on. I mean, the initial driver of the rally this cycle was emerging market central banks started buying. I think they started to feel, especially after the financial crisis, but more so after the Russia-Ukraine war, that their risk of their assets, dollar assets, being seized was something that they wanted to or didn't want to live with. So they started to diversify. Gold is obviously the natural thing for central banks to buy, but that has widened to retail traders. Retail traders are now starting to buy more and more gold out of Asia as well, I might add, and in Europe and the US. They were a little bit slow off the mark, but they certainly are participating right now as well. So you've got this rally that's kind of broadening, but what I think people are really worried about really is gold is a tail hedge. It's not only is it an inflation hedge, when I say inflation, I mean extreme inflation. It's also a deflation hedge as well. So the two tails of inflation is when gold tends to do best. It's not an overall inflation hedge, because when inflation's kind of petering around the middle, gold's not necessarily going to be the thing that's going to salvage your portfolio. But at extremes, it's something that is beneficial for portfolio. People think Bitcoin might be an alternative, but in this environment, I think it's untested. Bitcoin may end up pulling through the next kind of crisis that we have, whether it's governments debasing their currencies or there's some sort of private credit event and there's debt deflation. But at the end of the day, if you want to take insurance, you probably want to go for something that has worked in the past, and that applies to gold.
Simon, great to have you on the program. Look forward to reading more of your reporting. Bloomberg's Simon White. You can check out the stuff he does by typing MLIVGO on your Bloomberg terminal. By the way, we're going to talk more about gold as well as diamonds, both real and lab-grown diamonds, with Ankur Daga, Angara co-founder and CEO, in the next hour as we approach this holiday season. Coming up the next hour, Moneta's Ethan Devitt says the huge gains in gold and silver don't support their characteristics as diversifiers and inflation hedges. We'll get that take next. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Dani Berger is on assignment. We're seeing just slight gains on equity indexes after the big drop that we saw on Friday, a drop of more than 1%. It looked like when we saw futures up more than 0.5%, we would recover a lot of that, but it doesn't look so much like that in the cash trade. Coming up, payrolls hit tomorrow, and the stakes are high as investors look for clues on inflation and the strength of the rally. Is the $100 billion M&A boom set to continue as Wall Street bets on 2026? We'll talk to Michelle Davis about that. And gold's surge meets the holiday sparkle. Angara CEO Ankur Daga talks to us from the C-suite about the bling that's bringing in buyers. Let's turn, though, as our top story to the M&A market. Data compiled by Bloomberg shows global transaction values this year coming in at $4.5 trillion. That's the second highest tally on record and includes the biggest haul of deals valued at $30 billion or more that we have ever seen. Bloomberg senior deals reporter Michelle Davis joins us now on set. And Michelle, I was just talking with Kate Moore at Citi about these animal spirits. Looks like we're back in full swing as far as M&A is concerned, as far as IPOs are concerned. Does that continue into 2026?
It seems like all signs point to yes. And if anything, a lot of what the deal makers have been telling us is that it's crazy that this year was so good, considering that there was a huge pause after Liberation Day. And if it hadn't been for that, this year probably would have been a record. And all signs are pointing to next year being more of the same and maybe being another record, beating 2021.
So what's behind this? Is it more certainty now on tariffs? Is it, the Fed cutting rates? Is it this administration working to reduce regulation? These are all things I've heard from CEOs. So which is it?
It's all of those things. And it's not that any of the uncertainty has gone away. It's just that CEOs, boards have gotten comfortable operating with this uncertainty. And there's also a bit of this FOMO mentality going on where you're seeing companies shoot for the stars. They're doing some of the biggest deals they've ever done, in part because there's a perception that the regulatory environment is permissive of that. And so if you're company A and you see your biggest rival doing a mega deal, you want to partake in that too, because if anything, it feels like investors are going to punish you if you're not taking advantage of this, multi-year window where it feels like you could do anything you want and it's going to get through.
So we have seen a lot of very large deals, and we've seen a lot of big breakup fees as well. Are we hitting new record territory on those issues?
We are, and the other record that we reached this year was we saw the most number of mega deals, over $30 billion ever. For the past few years, we hadn't really seen any deals above $30 billion. And now we're seeing, Warner Brothers, $80 billion, the big railroad deal, a sector where you hadn't historically seen a lot of consolidation, $80, $90 billion deals. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal. The one interesting thing about that is because we've seen all these mega deals, we've actually seen fewer overall deals. So overall deal count is down, volume's obviously up. But it seems like companies are just aiming bigger. Instead of doing 10 tiny deals, they're doing one really big one.
I love to look at the time series on MA and this goes a long way to explain those convergent lines. All right, so how much of this is AI driven? I mean, I saw on that chart TMT, but that could be, Warner Brothers or NVIDIA, right?
Exactly, or Charter Cox, which is another one of the mega deals. A lot of it is AI driven, though, because that's part of what's driven, as we all know, the rise in the S&P 500. And so, sources say that if that continues next year, we will continue to see more M&A. That said, it could also be what causes some of this enthusiasm to stop. If for whatever reason, companies or investors get a little spooked that we've gone too far on AI, that could lead to a pullback, and then it could mean that M&A volumes slow down a little bit.
By the way, Joe has pulled up the MA function. This is something I've been messing around with for 25 years now, and it's one of the coolest places on the Bloomberg where I would guess you spend a lot of your time as well. Here we're looking at deal count in the chart, deal count and volume, the green line kind of dipping down. Is that going to pick up before we hit New Year's Eve?
The deal count, we're kind of at the end of the year here, so to be determined, but I would probably say unlikely. But
when are your busiest times? I know that I heard once from Crystal C that like Labor Day weekend is when the M&A team is in the office the whole 48 hours.
Right. Right now,
what about this break?
This break, I mean, right now it seems like there's no non-busy time, and especially when markets are closed, that's when companies take advantage of, their stocks not moving to negotiate high-stakes deals. And so, I mean, I'm supposed to be taking vacation over the next couple of weeks. We'll see if that actually happens, especially given the Warner Brothers situation that is still developing with Paramount, likely to start a bidding war. So, TBD.
So we expect, just on that one specific deal, and we're hearing from Netflix again reaffirming their position, do we expect these bidders to start upping the ante a little bit here?
So where it all stands now is, as we know, Netflix, Warner Brothers signed a deal. So that deal is signed. Paramount has come in with a hostile tender offer. The ball is kind of in Warner Brothers' court now to say, after deliberating with its board, to say, we view Netflix's board as either superior, or Netflix's offer as either superior, or, we think the Paramount offer is interesting to us. They might leave the door open to Paramount then coming in to up its bid. If that were to happen, it'll all come down to kind of who wants it the most. As the incumbent, Netflix does have an advantage here because Paramount would have to pay them a breakup fee to break this deal, and they'd have to top whatever they had offered. But as we know,
So I'm interested to hear the terms of this breakup fee, because these are massive numbers, right? $5 billion, $5.8 billion. If the FTC comes in and says no Netflix Warner Brothers deal can happen, or if the Department of Justice sues to quash that and is successful, who then has to pay the breakup fee?
So there are two breakup fees. One of them, $5.8 billion, is the breakup fee that Netflix would have to pay Warner Brothers if, for whatever reason, the DOJ in this case were to succeed in blocking the deal.
So if regulators stop it,
yeah,
Netflix has to pay that breakup fee.
And then if Warner Brothers scuttles the deal and chooses, decides to go with someone else, or if, shareholders don't approve the Warner Brothers deal with Netflix, then Warner Brothers is technically on the hook for about a $2 billion reverse break fee. But what happens in a situation where there's an interloper is, Paramount in that case would then absorb Warner Brothers' liabilities. So they'd be paying the breakup fee to Netflix.
It's fascinating. It's worth giving up vacation over, don't you think?
Yeah, I mean, biggest deal of the year in years, highest profile. Yeah.
All right, Michelle, great having you on set. Thanks so much for joining us. Michelle Davis there from our deals team. Let's get a check on what's going on in markets. We are 37 minutes into the session, and we're looking at green arrows turning red here. So very little change on the benchmark indexes, but going from gains to losses on the NASDAQ. Let's get a look at some of the single stock stories that we're following for you. A lot of this has to do with M&A. So ServiceNow is in advanced talks to buy the cybersecurity startup Armis in a deal that may value the target at as much as $7 billion. It would reach the tech company ServiceNow's largest acquisition ever. Intel, by the way, is looking to acquire AI chip startup SambaNova. This, according to people familiar, who declined to be identified, for $1.6 billion, including debt. Sources telling Bloomberg a deal could come together as soon as next month. And shares of Tesla gaining this morning, on pace to close at their first all-time high since last December. So Tesla shares could hit another record, defying concerns about the company's soaring valuation. Coming up, Wall Street strategists see a great sector rotation after years of the Mag 7 driving market gains. We'll discuss when we come back. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Federal Reserve Governor Stephen Miran says inflation is now close to the Fed's 2% target, and he argues policy is too restrictive. He expects rent and services inflation to ease and warns that keeping rates high risks sudden job losses. Miran is pushing for faster rate cuts to bring policy back to what he sees as neutral. He spoke at an event earlier today at Columbia University. CLO managers expect a boom in buyouts to drive profits next year. With borrowing costs falling and M&A rebounding, leveraged finance demand could nearly double. JP Morgan sees LBO and M&A loan volumes surging, and banks have already underwritten billions for next year's deals. But tight spreads and a crowded market could pinch returns, even as CLO issuance stays above $150 billion. And bad news for your carpets. Roomba maker iRobot has filed for bankruptcy and plans to hand control to its main Chinese supplier. The Chapter 11 plan wipes out shareholders after years of falling sales, supply chain strains, and a failed Amazon takeover. iRobot says it will keep operating as it restructures heavy debt. Turning back to the markets, Kate Moore of Citi joined us last hour to talk about what she sees for markets in 2026.
We're in an environment where people have had a good risk on year, and they're starting to get a little bit antsy about their overall positions. I would classify sentiment as kind of tepid at the moment, and you've seen this in terms of some of the rotations happening in the market in this final month of the trading year. But what I would say is we're actually seeing plenty of good reasons to think that nominal growth is going to be strong in 2026.
Could 2026 also be the year for a great rotation away from Mag 7 stocks? Bloomberg's Alexandra SambaNova joins us now on that story. And, you know, Kate Moore says she doesn't want to rotate for rotation's sake. But you actually see earnings of other sectors catching up to, you know, the big gains we've seen in these big tech stocks.
Yeah, Matt, I feel like for years we've been hearing people say that tech valuations are a concern, and anyone who's heeded to that advice over the past 3 years has missed out on something like a 300% gain in the Mag 7. So I keep asking people what makes this time different. Why is it finally going to be the rest of the market and not those big tech companies? And they make the case that first and foremost, big tech's dominance is now not just elevated, but at extreme levels. It comprises about 35% of the S&P 500. So not a lot of room for disappointment there. The AI story is also shifting. It's no longer about just telling people how much they're spending on AI, but actually how they're going to monetize those investments. And then, as you mentioned, of course, earnings are going to be a lot better for the S&P 493. If you look at the first quarter, for example, of next year, Mag 7 is expected to post growth of 15% and the S&P 493 of about 11%. So that gap is really starting to narrow.
Yeah, I mean, previously we were talking about the Mag 7 earnings growth at 50% and the 493 at 5%. So this is a real shift. What are the industry groups that people want to rotate into? Because I saw financials, for example, hit a record high on Friday as the rest of the market was down.
Yeah, it's going to be the old economy sectors, financials, industrials, healthcare. Basically, there's this view also that it's not just concerns about whether we're in an AI bubble and high valuations, but there's this optimistic view that the economy is going to reaccelerate into next year. Donald Trump's tax bill is going to bode well for some of those sectors. Fed easing, so it's going to be transports and manufacturing, and they're calling it the run it hot trade. That's what Mike Wilson said this morning. Bank of America's Michael Hartnett also said it's going to be about Main Street and not Wall Street.
How much of this is dependent on the Fed cutting rates? You mentioned Mike Wilson. He also said right now, you know, bad news is good news, because if we get a weaker labor market, we can have more rate cuts. Is that necessary for this rotation?
Yeah, it is, as long as the Fed is on track to ease policy. It doesn't really matter how many cuts we'll get, but as long as the direction is toward easing versus a spike in inflation that could trigger potential hikes. But we heard Jerome Powell say that they're not quite there yet, so that is going to bode well for the rotation.
So if I look at the industry groups year to date, obviously it's the hyperscalers that have done the best in terms of stocks. Then the IT companies are the second best. You expect them to give up that dominance and move down the rankings?
Yeah, well, we're already kind of seeing that underway. If you look at the last several weeks
Joe's
from that November 20th low, it is, you know, you look at small caps, they're outperforming the Mag 7. The Russell 2000 is up about 11% from November 20th versus the Mag 7, which is up about 5%. We're seeing the Dow Jones Transportation Index doing very well, and notably the S&P equal weight up over the cap-weighted index. So we're going to see that shift kind of continue like we've seen in recent weeks.
All right, Alex, thanks so much for joining us. Alexandra SambaNova from our stocks team talking about the great rotation that many investors expect in 2026. Coming up, AQR Capital Management is making a big comeback, seeing record asset growth this year and pretty darn good returns. But why? What are they doing right? Will they tell us? This is Bloomberg Open Interest. AQR Capital Management is riding high again following a few rocky years. Sources tell Bloomberg the hedge fund manager's assets have grown by a record $65 billion this year, reaching $179 billion and approaching prior highs. Joining us now is Bloomberg cross-asset reporter Dani Tsikova, who braved the cold and went to Greenwich. That's where their headquarters are, out in Greenwich?
Greenwich, Connecticut. Yeah. Yes, that's where they're based. The company had a pretty rough few years. Some dubbed those years not only for AQR, for quant's more generally the quant winter. It was around 2018, 2020. You know, value wasn't necessarily working. And AQR at that time had like a record amount of assets. They had about 226 billion. They halved that assets pretty fast in just 2 years. And now something pretty impressive is happening. They are increasing their assets at record pace, nearly 70 billion this year. A lot of it is performance. A bigger part, of course, is from inflows. But they have a new things that are apart from that, you know, value, momentum, what everyone knows them. They
factors to watch.
Yeah, factors to watch. But there are other things. They do tax aware. They even have a multi-strategy, which is kind of the space you would think of Millennium and other hedge funds like that. But they have a multi-strategy. They have new approaches to equities. They have all those alternative trend following in very, very niche markets. So the company has changed a lot. And this year, this is paying off.
Yeah, I mean, when I saw the story on tax-aware strategies last year, I thought, how do I get money in there? And I'm sure everyone else was thinking the same thing. Plus, they've had really impressive returns, as you point out right at the top of your story, right? 15 to 20% annual average returns.
For the last 5 years, yeah, it's really impressive. The tax-aware is really hot right now. We see other hedge funds. We saw Two Sigma recently launching those. Of course, there are only a few names playing in that space right now, which makes sense that AQR is growing very fast. It actually, for tax-aware, they tripled their assets in 9 months. So it's 45 billion now. It's growing really fast. And we looked at one mutual fund that does it, and it's a really small distribution, and the gains are pretty big, which is the problem with tax-aware. A lot of people are going for it, and then you get really good after-tax returns, but you're losing some of that alpha. So there is that trade-off. But yeah, their funds are doing well. Even trend following, which is actually doing as an index not too well, their trend following is doing pretty well.
But how much detail did they give you when you went out there? Because we have Cliff Asness on the program sometimes, and it's fantastic. He's a pretty open book. But the twist in your story is they're making more money but telling us less about how they do it, right?
They are a lot more secretive, and they do. They come on TV, they talk to us, but in terms of what they actually do, they say a lot less. They're talking more about the market, AI, and what's happening. But in terms of academic papers and things where they actually publish more about what their approaches are and what they actually do, they are publishing half of the pace they used before. And there are a lot of topics that they don't really want to talk about. I mean, they still say they're very open to clients, which of course makes sense. But there is a lot more secrecy about their presentations and things. And they had this kind of very open academic approach of just sharing everything. And maybe it's just a reflection of the world we are in. We find this differentiated alpha, and we keep it for ourselves, and that leads to better performance.
Yeah, I mean, it makes sense, right? If you have an edge, you want to keep it to yourself at certain times, and it does seem like they have an edge right now.
For sure, they have. But they're not like, we have Renaissance. We have so many hedge funds that are so secretive that it's almost impossible for us to figure out what's happening. They're not that far in the spectrum, but for sure, it seems like their secrecy is paying off and is rewarding some of those strategies. Even their simple equity strategies have changed so much over the years. They have the so-called adaptive models. So it leaves so little to the human that pretty much the machine decides everything and looks on their whole history of 30 years of trading. So it's pretty fascinating.
Yeah, I mean, being compared to Jim Simons it's a pretty good comparison.
It's a pretty good comparison.
To make. Dani, thanks so much. Bloomberg's Dani Tsikova covers cross-asset for us. Let's get a check on the stock market right now. We have seen a little bit of a turnaround here. So we're now down 0.25% on the S&P 500. Let's take a look at what's driving that. The breadth is now pretty evenly split. 265 winners, 238 losers. And we still see Tesla right at the top. This is a fascinating story. Investors continue to drive Tesla higher, and we're getting close, I think, to a new record high for this stock, the first we've seen in some time. Nvidia also a gainer today. Right now, it's only up 0.5%. Remember when we were looking at the chiclets, it was up about 1.25%. So giving up some of the gains that had seen earlier, and that's maybe one of the reasons that we're turning around here on the broader index. Broadcom is a loser today. We saw that Oracle is a loser as well. ServiceNow falling, Apple, Microsoft, Amazon, Google, Meta, all down. There's a great piece on Bloomberg Intelligence about the fact that a lot of the hyperscalers that we're used to seeing just pump out, just churn out cash, are going to be posting negative cash flow after dividends, after buybacks next year because of the incredible CapEx investment. We're going to talk about that later on in the program. Here's the breakdown in terms of the GICs, the industry groups. You can see that healthcare, you saw Eli Lilly up there, and utilities are leading the way, as well as consumer discretionary. But IT, energy, and communication services, the hyperscalers here on the downside as we get into the trading day. Coming up, we get a read on the jewelry industry as gold races back to record highs. Ankur Daga, Angara co-founder and CEO, who normally talks to us about lab-grown diamonds, is going to talk to us about the precious metal next. This is Bloomberg Open Interest. Gold is nearing another record high as the AI bubble and U.S. borrowing cost concerns linger. The rise, which has been just amazing to watch, you can see here from this 5-year chart, continues as we get towards the holiday shopping season. Let's get a read on the jewelry industry in general with Ankur Daga, Angara co-founder and CEO. Angara.com is an online jewelry retailer. And we always go to Ankur for the intel here. Great to have you back again. Thanks for joining us. What do you make of this run-up in gold? I mean, how has it been for you as a jeweler?
Oh, it's fantastic. So average ticket is up 15%. Unprecedented, really, 50% rise in the last year. It's doubled over the last 2 years.
Just in the underlying commodity?
Just in the underlying commodity. And silver and platinum, by the way, have gone up 70% in the last year, so pretty phenomenal run.
Why is the average ticket, then, of the items you sell only up 15% when the price of gold is up 50 and silver and platinum are up 60 and 70%?
Yeah, so the bulk of the asset value is really in the gemstones and diamonds, and lab-grown diamonds are driving the price of diamonds down. So there's an offset there that's greater than the value of gold.
That's pretty amazing that it offsets it that much. But before we get to the lab-grown diamonds, I just want to stick to gold.
Yeah.
What do you see as the drivers behind this?
Uncertainty, political uncertainty, economic uncertainty, money printing, all three are alive and well and going to increase in the future. So I think people have really bought into that. And I think gold will continue to do well. Just historically, over the last 10 years, gold had appreciated 11% per annum. S&P is up 12%, so it's actually pretty close. Interestingly, over a 30-year period, there's zero correlation between the S&P and gold, so people are thinking about it as a hedge. And I think that's here to stay. And that will go to either gold or something like a Bitcoin. And over the next 10 years, I would imagine some of this run continues. Maybe not at a 50% pace, but it will do fine, I think.
So when you go to the market to buy gold, against whom are you competing? Is it, other jewelers, Indian, savers, other central banks? Who's buying it?
Central banks are buying right now roughly 25% of the gold that's out there. You're competing against financial investors as well as jewelers predominantly. But surprisingly, the financial investors are a much bigger part than people would think.
I was wondering about a piece of gold jewelry, if you don't have a gemstone in it, right? How much do you charge above and beyond just the weight, just the cost of the asset?
So there's a few things that go into it. One is labor charge. Second is when you're crafting a piece, you lose a certain percentage of gold. So it can be anywhere between 15% upwards to double, depending on exactly what the piece is. And that will go up more if they're studded with gemstones or diamonds.
And the gemstones, we have talked to you a lot about these lab-grown diamonds, this phenomenon that's really driven down the price. It's driven down the price of natural diamonds as well?
Yeah, so natural diamonds are down roughly 45% from their peak, which was March of 22. So pretty phenomenal. When all the other assets are doing really well, diamonds have struggled because lab-grown is a perfect alternative.
And what's the adoption rate look like to you? Because I'm sure at the beginning a lot of people were unsure about lab-grown diamonds, even though they can't tell the difference even under a loop, unless they're extreme experts, right? A lot of people still want the safety of something that they're told is natural. Is that lessening?
Yeah, so this quarter, roughly 60% of engagement rings sold in the US will have a lab-grown center. That was 2% back in 2018 when the FTC said a lab-grown diamond is a real diamond. You just have to disclose that it's lab-grown. So 2 to 60% really in 7 years. Pretty phenomenal growth, and we don't see that slowing. I think we get to 80% adoption in the next 10 years for this.
What does this mean for other gemstones? I mean, can you grow lab-grown sapphires, emeralds, rubies?
Yeah, absolutely. So that's been happening since the 1980s. I think the difference is what we're seeing. We're agnostic to whether we sell natural lab and for gemstones and diamonds. What we're seeing on
you don't make a bigger markup on either one?
The margin is slightly higher for lab grown, but then the average ticket ends up being lower, so it's kind of an offset that way. What we're seeing on the color side is 75% of what we sell is natural, 25% is color, is lab. And I think the reason for it, there's just like a spiritual aspect to resonating with the piece itself that you see much more in emeralds, rubies, sapphires. All of them have inclusions, and the inclusions are what make it more human-like in nature, whereas lab-grown tends to be perfect. On the diamond side, the adoption curve is very different. So 60% plus is lab, 40% is natural.
Well, because customers, they want a perfect diamond, but when it comes to a ruby or a sapphire or an emerald, they'd rather see a unique imperfection.
Yeah, so we've been trained with this idea for diamonds that a D-flawless, so essentially colorless and flawless is the singular idea of perfection. That doesn't exist in color. There's 50 different shades of emeralds, of greens, and you and I might like very different shades. So you might like a Zambian emerald deep forest green. I might like more of a Colombian shade, and that doesn't necessarily happen with diamonds.
How's the business as we get into Hanukkah, closer to Christmas? What's it looking like relative to last year, let's say?
It's fantastic. We're up over 30%. We're growing very quickly. The industry overall is up over 10% this year, so jewelry has had a phenomenal year. In fact, of all the luxury categories, jewelry is doing better than handbags and everything else. And I think it's partly driven by gold, and the people feel like it's much more of an investment than in years past. So we're seeing that we're hyper growth right now.
All right, well, it's great to have you on again. I hope you come back and keep us updated on the market for jewelry. Ankur Daga there is the CEO of Angara. You can find his jewelry at angara.com. Now let's get a check on what's going on here in markets after a turnaround. We're looking at big, well, decent gains in futures, 0.5/6 We opened higher and now have turned lower as NVIDIA has given up some of its gains. The NASDAQ now down 0.33%. Big tech's cash machines look to be sputtering, with CapEx exploding and buybacks piling up. The hyperscalers that once minted free cash flow could flip negative in 2026. Robert Schiffman did the analysis for Bloomberg Intelligence and joins us now on set. And Robert, this BI piece is so fascinating. I guess part of it depends, at least according to your subheader, on how you determine or how you define free cash flow, right?
Well, that last segment was pure gold. I hope I could
live up to it. Thank you. I really appreciate it.
Yeah, listen, there's a lot of concern and risk in the market right now, much of which people think is systematic. We actually think it's much more idiosyncratic. But what we've done is try to break down every one of these hyperscalers' borrowing needs for the next year. And it's probably a little bit greater than what the market anticipates, but probably not as great from the total amount of borrowing that this market expects. People are throwing out trillions of dollars of borrowing. We don't think it's anywhere near that.
So on the chart in your piece, I see Meta, Microsoft, and Oracle could have negative free cash flow. Now, this is after they return money to shareholders, right? Buybacks and dividends. Do you always measure it that way?
No, the traditional measure of free cash flow is just operating cash flow less CapEx. But I think what we really have to think about is how much these companies really need to borrow or spend next year. And some of these companies spend tens, if not 50 or even 100 billion when it comes to Apple in terms of shareholder returns on an annual basis. So we're looking at net free cash flow these days. Quite frankly, though, it's still really not that scary. What's scary is when you move down the credit curve to triple Bs, double Bs, single Bs, but not so much the single As, double As, triple As, or the Mount Rushmores of credit.
Yeah, I mean, these companies are the Mount Rushmores of credit. Like, we have been writing pieces this year about how Microsoft may be safer debt than U.S. Treasuries.
Yeah, well, they're rated higher. Yeah, again, there's just this panic in the market. I think much of the panic is really coming from the equity market because we're way off highs. When you think about credit markets, though, we're a little bit wider year to date, but not that much wider. And there's one or two names like Oracle or CoreWeave that have really sold off a lot, but I don't really think are indicative of what this market should be expecting over the next year. We're going to see a lot of borrowing. There's going to be a lot more debt, and high-grade bonds in the tech space are probably likely to continue to underperform mildly, but that's a lot different from an AI bubble, panic, blow-up. Like, you don't have to stash your IG corporates under your pillow with your cash. Like, in general, you're going to be fine.
Spreads, though, I guess will remain very tight. Is that the outlook?
I think so. I think they're going to remain somewhat range-bound and reasonably tight. That doesn't mean we can't leak wider or we can't underperform mildly on a relative basis. You know, what happens when you issue 100, 200, maybe even $300 billion of debt in a year, which are historical highs? People start getting full on these bonds, right? It takes that much more of a concession to sell more bonds. And what that does is it pushes bonds a little bit backwards. In addition, what we're seeing is tens of billions of private transactions. And what happens, if you can buy a private deal 50, 100, 150 cheaper than public deals, it also helps push back some of those public deals. So it means we're probably, again, going a little bit wider, but I want to differentiate between this world is blowing up to it's okay, don't worry so much.
So, I appreciate that. Always interested in the voice of reason on this program. In terms of the demand for private deals, if you can get that kind of bargain, how many more people are pushing into private deals and how many people can get exposure to that?
Yeah, there's some real benefits. The first big benefit of doing some sort of SPV, some special purpose vehicle, is that rating agencies won't count that as full debt. So somebody like Meta can issue, $27 billion of debt. It doesn't move their credit ratings at all. We think others like Oracle could use that $30, $40, $50 billion of off-balance sheet debt, which will help them protect their investment grade ratings. Then on top of that, there's a whole new market out there. It's not that new anymore, where people are looking for incremental yield. I mean, overall yields are really not that high based on historicals. So if you're looking for incremental carry, the private market is the way to go, and I think there's enormous demand there. There's still enormous demand for the public bond markets, but when you can make bespoke private transactions at a discount to the public, I think that appetite is voracious. So if you think that companies can't fund AI CapEx builds, I think you're just going to be flat out wrong. The question is really what's the cost of that going to be, but it's not whether or not the capital will be accessible.
Well, if you can do it also without affecting your credit rating, that doesn't mean your CDS is going to stay cheap, right? We've seen Oracle really pick up. Does that mean anything to you?
Well, that's a great point. You know, what happens in the CDS market is not just worry about a stock going down or leverage going higher. It's how do banks hedge their positions? If Oracle has pre-sold effectively $38 billion of data centers, that's not out in the market yet. Banks have probably already hedged that. If there's another 15 or 20 billion of those transactions to get priced, banks are going to start hedging those again. And then the next thing about CDS is that, remember, this is a contract market. So there has to be both a buyer and a seller. There's a lot of buyers right now. There's not a lot of sellers. So if you have one more incremental buyer, it really can push the market a lot wider. I think that's what's happening. I don't think it's representative of true credit risk. I think it's much more to do with technicals.
All right. Hey, it's great to have you lay this stuff out. I hope you come back. Robert Schiffman there from Bloomberg Intelligence. You can check out his work by typing BIGO on your terminal. Coming up, a shadowy global network helped President Trump make millions of dollars in meme coins. We'll talk about that in today's Big Take next. This is Bloomberg Open Interest. A few days before President Trump returned to the White House, the first couple launched cryptocurrencies that ended up plummeting more than 90% from their peak. And no one wants to take credit. Our latest Big Take examines the Trump family's crypto ties and the origins of meme coins. Bloomberg Businessweek investigative reporter Zeke Fox, who co-wrote the Big Take story, as well as Number Go Up, joins us now here on set. It's an incredible, eye-popping story. I mean, the list of characters that's hanging around this administration, from George Santos to a guy who teaches a course on how to cheat on your wife, is pretty amazing. Tell us about the story.
Yeah, so this was a big deal for a couple days in crypto world that the president and his wife launched meme coins right before the inauguration, but then it sort of slipped amid like all of the Trump craziness. So we decided to go back to the origins, and what we found was that there was basically this nihilistic, unregulated gambling game that swept the world. We interviewed one 22-year-old whose company generated $1 billion from it. And then when the president of, not just President Trump in the US, but also Javier Milei in Argentina, when these presidents found out about this, instead of being like, this seems kind of weird, maybe we should think of some regulations. No, they both got in on the game and made what seems to be tons of money.
So, and I mean, the Trump family has really gotten into crypto beyond just the Donald Trump and Melania Trump meme coins, right? I mean, they're constantly working the crypto scene. And do we have any idea how much money they're making off of this?
So I think that the Trump family's total take from crypto is something north of like $1 billion, maybe a couple billion. The meme coin itself, the Trump team and whoever they were working with, according to Chainalysis, they profited about $320 million, and that's in real money, not some hard to cash out crypto.
So, but the other people who bought the coin, I guess, are the ones who funded that, right?
Yeah, I mean, basically a meme coin is sort of like a zero-sum game. It's almost like a pump and dump scheme that happens out in the open. When a celebrity announces a coin, it's like, all right, the game is on. And the early people, maybe people who got a tip-off, they can make big profits. By the time regular people hear about it, they're often too late. So it's sort of like the winners and losers are going to cancel themselves out, minus the huge take that the insiders get off the top.
But players in this game know exactly what's happening, right? I mean, when you're buying a meme coin, surely you realize that you stand to lose all of your investment. I mean, one of the sites that you talk about is called pump.fun.
Yeah, I mean, we talked with tons of meme coin traders, promoters, creators, and what they said is like, yes, this game is rigged. We all kind of know it, and we're playing it anyway. People like to think that they've got an inside tip-off, that they're going to be the ones that know about it before like the bigger sucker comes in. But at this point, meme coin trading's really died down. I think the message has gotten around that this is a tough place for a tough casino to make money in.
So what's with the World Liberty Financial company? That's still an ongoing business that they haven't given up on.
Yeah, so at the time of inauguration, I mean, the Trumps had this World Liberty Financial crypto company, a little bit more serious. They were raising $550 million for it. They were in the process of that. That's when they dropped this meme coin and sold hundreds of millions of tokens for that. World Liberty has continued. They've actually created a product, a stable coin, a cryptocurrency backed by the US dollar. That's a very competitive product. There's really well-established stablecoins. The Trump administration has been creating rules for stablecoins at the same time as Trump himself is promoting this product.
It's not like this happened just at inauguration or before, right? There's a picture of President Trump with Bill Zanker in your story from 2013, so before even the first administration.
Yeah, so one of the guys behind Trump's meme coin was Bill Zanker, who made his name with something called the Learning Annex. And this was sort of a edutainment company where they had classes in, as you mentioned, everything from how to eat an avocado to how to cheat on your spouse.
Here's the picture, by the way. Fantastic pick.
He's done a lot of products with Trump over the years, like Trump Perfume. He paid Trump to give speeches at real estate wealth expos. But this meme coin is basically one of the best ways that anyone has come up with to turn hype, to turn attention into money. Instead of, trying to sell Trump sneakers at $500 a pop, you can just say, hey, buy this cryptocurrency. You don't even have to pretend like it does anything, and people will sink billions of dollars into it.
Wow. All right, it's a fantastic story, Zeke. I recommend everyone check it out on Bloomberg.com. Zeke Fox, the author there. Coming up, we're going to set you up for the busy trading week ahead. This is Bloomberg Open Interest. Traders bracing for a busy week of data. We get November payrolls finally tomorrow. October retail sales out then as well. Michael McKee, Bloomberg's international economics and policy correspondent, joins us now. Mike, I always look at WHIS Go on the Bloomberg terminal to get my take on what payrolls are going to be. I guess the survey number is we're going to add 50,000 jobs, but the whisper number is 21,000. And that's not at all a problem, right?
That would be a problem if it were true. We just don't know at this point. And of course, there's going to be a 2-month release in terms of the number of jobs created, only 1 month in terms of unemployment. So it's hard to know exactly what people are basing their choices on.
But by the way, what I'm getting at is we don't need to add as many jobs in order to keep unemployment steady as we have in the past.
But 20,000 is
right?
still below estimates of what we would need to do. Although, if you look at my list of things that we're watching for, you got 119,000 payrolls in September. The forecast we don't know for October, as Matt mentioned, 50,000 for November. The big unknown is we don't know what the impact of federal workers being furloughed is. They might not be counted, depending on when they were furloughed. And also the Doge ones, the ones who were fired or resigned and had severance until the 1st of October. Healthcare still hiring. Retail hiring weak. They didn't hire as many temporary workers this time. So those are the things that we'll be watching. But the market's really going to look at, and the Fed's really going to look at the unemployment number. 4.5% is the forecast, but there's no October unemployment rate. So again, not sure what that's going to be based on.
Just got about 30 seconds here, Mike, but we had Miran speaking, I think, at Columbia earlier, and saying that we could get inflation back down closer to 2%. How far away are we? Because we're going to get CPI, right?
Well, CPI we are expecting to tick up. We only get it on a year-over-year basis. We're not getting a month-over-month because there was no October. So it's going in the wrong direction for his argument. He says sometime next year it will come down, but that's what Fed officials have been saying for a long time.
It's always next year. This inflation is just transitory.
You'd think all these Fed people were from Brooklyn.
Mike McKee, Bloomberg's economics and policy correspondent. Coming up tomorrow, Michael Aron of State Street, Liz Hart of Newmark, and Julia Coronado of Macro Policy Perspectives. Plus, we're going to bring you Danny Berger's conversation with Citadel founder and CEO. You may have heard of him, Ken Griffin, from a conference in Paris. This is Bloomberg Open Interest.